Hello, good morning, good afternoon, everybody, and welcome to today's webinar. It's an important topic that we'll be covering today. My name is James Williams, the Editor-in-Chief of Private Equity Wire. So very much looking forward to moderating this panel today, where we'll be discussing key considerations when performing an ESG materiality assessment. With ESG becoming really a de facto feature of one's risk management program today, it's certainly becoming increasingly important for PE managers and all asset managers, for that matter, to materially assess their ESG capabilities. But how should one approach such an exercise? And what are the questions that they should be asking within their respective organizations, but also with respect to their portfolio companies as managers look to put an ESG program into place? So during this webinar, we will be discussing some of the practical considerations that managers should be thinking about, and also get some insight into what managers have already done and what they're thinking of doing. So we have a good mix of panelists today, very established manager and still an ongoing emerging manager for today, and we have our technology expert in place as well. So delighted to introduce Kylie Ford. Kylie is Principal Consultant for ESG at Gobi. I'll allow each of them to do their introductions in a moment. We also have Malcolm Kostachenko. Malcolm is a general partner at Enhanced Healthcare Partners, a US-based healthcare-focused manager. And in Europe, based here in London, is Stefano Bacci. Stefano is a partner and ESG manager at Ambienta, who are one of Europe's more prominent ESG-focused private equity groups. So thank you all very much for today. Kylie, I'll let you do a quick introduction, please. Thank you.
Sure, thank you. As James had said, my name is Kylie Ford. I'm a Principal ESG Consultant at Gobi Inc., and we are a software and ESG consulting firm. I myself have been an ESG consultant for over a decade, and day to day at Gobi, I'm working every day with private equity clients, particularly with consulting efforts such as materiality assessments, which I know we'll dive into a little bit more as we talk through this webinar, as well as we have software technology that's being used for ongoing investment management and within due diligence. That's been really helpful.
Excellent. Thanks, Kylie. Malcolm?
Hi, everyone. Good to be with you today. I'm a general partner at Enhanced Healthcare Partners. As James said, we're a US focused fund that's focused on the healthcare sector. And as we've seen the evolution of the healthcare world in the US, ESG is continuing or really starting to play a more prominent role in the services side of the business. So I look forward to diving in today.
Excellent. Thank you, Malcolm. And Stefano, delighted to have you on board as well.
Thank you very much, James. And thank you everybody for the attention. My name is Stefano Bacci. I'm a partner and the ESG manager of Ambienta. Ambienta is a GP, is a European GP. We have 4 offices, London, where I am, but also we have Munich in Germany, we have Paris, and we have, that's all, yeah, Munich, Germany, Paris, and London. We are specialists of environmental impact, so we only invest in business propositions with a positive and demonstrable environmental impact. I've been 20 years in private equity, so I consider myself a veteran of the sector. We run both public equity and private equity. Private equity is the bulk of our portfolio. Public equity is a newer startup in our firm in order to leverage the know-how we have in sustainability, the focus we have in sustainability on more asset classes. We, in private equity, invest deeply in companies mid-market, so 10 to 20 million EBITDA in whatever, just to give you an idea of what kind of company we invest into, 10 to 20 million EBITDA in whatever currency unit, euros, pounds, dollars.
That's great. Thank you very much, Stefano. And again, it's good to have a European and a US perspective here, and both of you and Malcolm are at different stages of your ESG evolution as respective organisations. So this should make for some interesting counterpoints today. I just would like to encourage those listening that if they do have any questions over the course of the next 50 minutes, please submit any questions just using the chat window in the webinar tool. We'll try our best to then go through and take a few of those questions. We would like to have some involvement with the audience so that we're touching on some of the issues you think you would like to hear about. So do feel free to share any questions. As I say, that will be most welcome. I think it would be good to begin really by really defining or explaining really what we mean when we refer to a materiality assessment, especially for those who are in their early journey of implementing an ESG framework. Kylie, I think I'd like to lead with you on this one, just so that we can set the context for what we're discussing today.
Sure, of course. ESG is a very broad topic. Obviously, it covers everything environmental, social, governance, touching your organization. So a materiality assessment is a way of narrowing in on determining what aspects are going to be important to you or material to your business that might materially impact your performance moving forward. So the process of going through a materiality assessment, it's an exercise in stakeholder engagement where you're going to be bringing in different perspectives, talking through, understanding the risks, and understanding the relevance of these different topics, and then aligning that to what your action is going to be moving forward. So it's a way of just making sure that whatever roadmap strategy you're creating for yourself, it's going to be angling towards the right things, and most importantly, collecting the right information, because it can be very quickly overwhelming if you're trying to capture just a bit of everything. So that's the bare bones of it. There's a lot more complexity we could get into, certainly, but it's almost the perfect first step. Anytime you're just wondering, hey, what's next on my ESG journey? Stop, make sure what you're doing is going to be relevant and what is going to matter for you and be impactful.
Yeah, and Stefano, Ambiente, you became one of the UN PRI signatories back in 2012, so almost a decade ago now. Could you talk a little bit about how you thought about putting your ESG program in place, and how you've taken a bit of a proprietary approach to that? Maybe you could share with the audience how you embarked on that journey.
Sure, very happily. I think for us, probably the starting point was the one that Kylie just referred to, materiality. Materiality is really needed. I mean, imagine as we are a GP mid-market, we are not a big organization. We manage about $1.5 billion now, but 10 years ago, it was much smaller. We had a fund for 200 million. So materiality is probably the beginning of the journey, where you try to focus down your approach to what really counts and what really matters. Probably things back in 2012 were less structured, and there was probably also less jargon, but every minute you subtract from the day of the investment team to look at ESG is somehow a negotiation, right? Because the deal team usually is entirely focused, at least in those days, on value creation. Probably now it's changed, because we also use ESG metrics internally for evaluating performances of the entire organization. So we started a program that we eventually labeled branded ESG in Action, that comprises now, after almost 10 years of refining, comprises 7 different steps. It begins before the investment decision is made, so in due diligence phase, and the 7 steps then follow the shelf life, the life cycle of a portfolio company in our portfolio, and it finishes with an analysis of the gap against the ESG action plan that we initially decided to implement and what has eventually been implemented by the management team. We keep enriching the program every year. We keep adding features. For example, 2 or 3 years ago, I think we decided to have carbon footprinting as a mandatory step of the program. It wasn't mandatory before, so the most recent acquisitions, they've all been carbon footprint. That means not only the carbon footprint, but you also have a carbon strategy in order to tackle the carbon footprint. The latest innovation we added is of last year, and now we have a third-party assurance at the end of the program that somehow help us explain to our LPs the breadth and the depth of the program in all its steps after it has been implemented. So it's certainly a journey where materiality is a very important first step, but then you grow from there and you can expand.
Yeah, and that ESG in action framework that you've created is evidence of how, yes, this has been a journey. This isn't something that happens overnight. You've got to put the right steps in place, and I believe you're also now extending that to how you yourselves think about ESG ambienta. You're not just applying this to your portfolio companies, but importantly, how you as an organization operate, Stefano, and this is about practicing what you preach.
Indeed, I think we started with the portfolio because our idea, and I have to take responsibility, primarily my idea at the beginning was that, considering our size and considering the size of our portfolio as an aggregate of companies, I always thought, well, better start from there because there is way more materiality, substance, than analyzing the GP. But after the program took shape and got better and better, we decided to also apply to ourselves. So we also carbon footprinted ourselves. We also have a carbon strategy ourselves, which have been board approved by our board of Ambienta. It's called a net zero policy. It's got several actions to reduce our emissions to a net zero. We also became B Corp in 2019 in this effort, also as GP, small organization, but somehow we wanted to make our part in order to, parallel move with our portfolio towards a better E, S, and G. Yeah.
And Malcolm, you're, I think, fair to say, in the early stages of formalizing your ESG program, and maybe you're still going through that materiality exercise. Presumably, could you talk a little bit about how you're thinking about this at the moment and how you see it as being a more important, a more prominent component of how you think about due diligence going forward, and also, as Stefano referred to a moment ago, the ongoing life cycle of your portfolio investments? Where are you at the moment, and what are you thinking about it, Enhanced Healthcare Partners there?
Sure. I think a key component of this is, as Kylie mentioned, is getting all stakeholders aligned in working through what you're going to manage. So we turned it a little bit internal first and said, hey, let's make sure all of the deal partners who are in charge of our portfolio companies buy into this, because I think this is something similar to other metrics that you measure, whether they be compliance or financial or operational, that you can't manage what you don't measure. So the first part was make sure we have buy-in from all the general partners and all the deal partners, and then start to put something in place that you can measure. And then how we started was trying to tackle it in bite sizes, because unless you're working with a consultant who really understands your business and your portfolio companies, a lot of the information can be overwhelming. And then when you turn it on your portfolio companies, we found if you're not really crisp and purposeful on what you want to measure, you don't get results, and then it just becomes another thing they have to do. So in our world, in middle market healthcare in the US, it was easiest to tackle the S piece of ESG, especially when you're thinking about, if you're on the services side, presenting high quality care in a low cost setting and greater access to care. It's been easier for our CEOs of our portfolio companies to tie in the social piece of ESG and put in a few simple measurements. And then the next logical step is the G piece and the governance, especially on some of the companies, if they are middle market companies that may not have that piece or may have had family office investing or angel investing and are now trying to take the next step to formalize or institutionalize their platform. That's an easy bridge from the S. So we've made sure that we get the buy-in at Enhanced Healthcare Partners first, and then try to go out in bite sizes to get the CEO portfolio companies on board. And I think inertia, has really helped over the past 2, 3, 5 years, as opposed to, as Stefano mentioned, trying to do this in 2010 and 2012. It was much more of a challenge.
Yeah, definitely. I mean, arguably, there's so much focus on this big concept that is ESG. There is so much information out there now. There's so much being talked about. It's almost, Kylie, one of the challenges for managers a little like Malcolm's, who are a little earlier in their journey to thinking about this. One of the things they have to contend with is that there are so many different frameworks out there today. Every investor's got their own different type of questionnaire that they want managers to fill in during their due diligence. The regulators, you've got the SASB accounting framework, you've got the Task Force on Climate Change related financial disclosures. I mean, it's almost a bit of a spaghetti of frameworks, and how should managers really think about this, would you say, Kylie, in the early stage?
Yeah, at Gobi, we call it the alphabet soup of the frameworks in the ESG world. There's definitely no dearth of them. And honestly, it's quickly becoming someone's full-time job just to be able to respond to different LP questionnaires, because they're all in slightly different formats. And then everything Malcolm was saying is music to my ears. What do you then ask about your portfolio companies? You need to make sure that it's clear, that it's easy to answer, that it's going to be uniform, so you can begin getting those data pieces. So really, I'm going to sound like a broken record every time I talk about materiality, but that is why it's very important to immediately orient in the things that are going to be relevant to you, making sure you're collecting information about your own organization as well as your portfolio companies, so that for any of these disclosures, you're going to have that quickly at your fingertips and be able to disclose. Those exercises will also help determine really what frameworks might be the most beneficial for you, especially if you're engaging in your stakeholders with your LPs or investors or whomever, to find out really what it is that they're after. Likely, a lot of times they put together these questionnaires in the same way that a lot of private equity companies are putting together questionnaires right now. You need something, but is it targeted? So that's why going through the materiality exercise as a collaborative effort can be really helpful. Another thing I wanted to touch on briefly is that what we built a software solution based on what we were seeing as being this need for collecting information from portfolio companies and beginning to get that data point so that you can report on what's happening. So at Gobi, it's called the ESG Index. And this is a tool that basically you can send out questionnaires in stages to portfolio companies. And the first questionnaire is going to be more qualitative, higher level in nature, just to understand what's the maturity of our portfolio companies' ESG programs, what do they have in place regarding policies and certain things like that. And what's really nice about it is that it assigns a score, not meant to be punitive in any way, but so that you can be comparing apples to apples across all your investments, and then also quickly leveraging opportunities for best practices. Let's say you have one portfolio company that, as Malcolm was saying, is a standout, has all-star social policies in place. Maybe there's something you could take from there and help apply it. A second phase of the ESG index would then be more quantitative tools that you'd be collecting. Maybe you want to collect actual energy usage or a key KPI like that determined by your materiality. The idea is that you do it in phases so that your portfolio companies can become introduced to the concept of disclosing on ESG performance, and so that you'll also be able to go back to investors, LPs, saying, here's our method of what we're collecting. And then certainly what Stefano said as well too, making sure you're walking your own walk can go a long way. If you're asking portfolio companies to disclose GHG emissions, maybe that's something to consider internally too. So it can help almost drive your own internal ESG program at the same time. So more and more we're seeing, private equity managers gravitate towards solutions like this and just begin getting the baseline so they can understand how current portfolio is operating, and then, working through that process through materiality assessments with LPs to make sure any information provided is relevant.
Got it. And yeah, so that's allowing managers now to assign a score, as you say, are using one of these indexes that they're able to create, this ESG index, and that is interesting how they can then monitor and measure KPIs across their portfolios. So that there's certainly, that's a way to once you've got that baseline of data in place, that's a great way of being able to track progress. Stefano, have you how have you approached the whole need really to get that baseline of data in place, of data sets, I should say, in order to then begin to think about how you monitor your portfolio companies and how you track their performance?
Yeah, it's a very good question. I mean, reporting ESG is one of the most complicated things, I think, because reporting on financials now, is totally standardized and it's relatively easy. Reporting on ESG, what is ESG? There is so many interpretations of ESG. We are a sustainability investor, and I don't know how many, maybe even of our own investors, can truly draw a line between sustainability and ESG. A line which for us instead is crystal clear what is a sustainability investment and what is an ESG performance. So reporting is difficult. On ESG in particular, we report every quarter to our investors, company by company. Though I have to say we are not KPIs obsessed. We have 5 KPIs or 6, I'm not sure, I think 5, we canceled one, that we collect across portfolio companies and we report to investors once a year, numeric KPIs. Then every portfolio company has a set of individual KPIs according to their own ESG action plan. Every company has got a different materiality, logic, reasoning, which eventually delivers an ESG action plan company by company, which is always different. It includes actions that are aimed at curing a problem, but it also includes actions that are preventative in their nature and they not actually address any problem. They just address staying away from problems, typically certification programs, quality certification, energy management, etc., to make sure that there is a foundation of good practices. So we are not really KPI obsessed, and we are more activist in our engagement. Portfolio companies report on ESG performances monthly to us in our board meetings with the portfolio companies that we usually do in person, or we did in person once a month. Usually one of the first 3 pages in ESG summary progress. We internally discuss our portfolio companies once a quarter, and one of the 5-6 slides, because we want to be focusing on the key points, is ESG. So there is a data flow that comes out from the companies, and then there is a data flow that from us goes to investors. We do collect KPIs, but we are not obsessed by KPIs. We're probably, as managers, more obsessed by management action, making sure that they address the right things, that they do the right things, and that there is progress against the plan. Now, like everybody else, then we are flooded with questionnaires, and there is always the issue of filling those up. They become increasingly thorough, I have to say, insightful, complicated to fill up. It requires senior people to fill them up. We can't. We tried with juniors, but it doesn't work because they're senior questions in a way, and they require senior attention to explain what we exactly do. They're probably all different, which is another issue. There is somebody that focused. I mean, I received one not long ago that was all entirely about NOx. Now we don't monitor NOx, so I didn't have anything to write. The conclusion is Ambienta doesn't do any ESG. No, sorry, I apologize. We do. We don't monitor NOx, but all these questionnaires was about NOx emissions. I don't know. Maybe somebody told them that. I think something that should become the standard is probably the PRI approach, which is incredibly articulated. I mean, this year's version, at least our version, is 368 pages, but there is already some LP that draw from that database or that data set to then draw their own conclusions. I'm thinking, for example, well, probably better not to make names, but there is a few LPs that are using PRI reporting as a platform, and that's useful because PRI reporting is very extensive, it's very complete. We take it very seriously. PRI reporting for us requires a board approval, and we also have PwC certifying it to make sure that it is totally adherent to reality. And I think probably in terms of standardization of LP requests to GPs, that could be a good common language between the parties in order to be able to optimize the data flow, the information flow from GP to LP.
Yeah, yeah. I believe you also now have third-party certification of your ESG in Action program. Is that right? I think OPWC are overseeing it.
Yeah, as I was mentioning earlier, we introduced now in our ESG in Action program this extra step where we have one of the big four to basically, it's not an audit because it's not auditable, it's an assurance where they go dig and they certify to investors that what we have done is entirely coherent with our declared program of actions. Yeah,
I'd like to get Malcolm, is anything that Stefano's been outlining there in their journey that you feel could be relevant to enhanced healthcare partners in terms of maybe the way you think about KPIs, just the way that you're really trying to build internal accountability for how you're monitoring your ESG program? Anything that you would like to respond to, just in terms of where your thoughts are at the moment with this?
Yeah, no, absolutely. I think Stefano's point of, hey, this is not complex, but it requires senior attention is an important one. You know, in some of our portfolio companies, if you just send them a blank questionnaire, and what we started with early, you know, there were a lot of things there that required a couple of questions on top of the questions to know exactly how you should answer and what was relevant. So I think Stefano has gone through a lot of that to ensure that they're hitting on all the key topics that's pertinent for their portfolio. I think for us, because we are a sector-focused fund and in the US almost exclusively, I think we are starting to zero in on the type of resources and questionnaires that can be more uniform across our portfolio companies. When we initially rolled it out years ago, to Kylie's point, we had an alphabet soup that came back to us. And then in order to try and standardize that, it got to be pretty cumbersome. So I think the point of making sure you have buy-in at the senior level and keeping it simple, you can always build on it. I've seen some of my peers that say, hey, I just need to do this because my LPs are answering or asking questions, kick it to their portfolio companies and then come back. I mean, that was maybe phase one or phase two, and that doesn't work, as we all know. So I think it's really important to get senior level attention and buy-in. And now we've narrowed it down, and some of our companies do a better job than others in reporting some of the key elements of what we need. So keeping it simple and standardization with high level buy-in, I think, at least in our experience, that's a good way to continue to build on it. And then it becomes part of their regular cadence, their regular reporting. They get to talk about it, and it's not just another questionnaire or something that the GP is asking for.
Right. Yeah, it is. That is an important point about just really making sure that management teams understand really what it is you're asking for and why you're asking for it and what it is you're trying to measure. Which sounds obvious, but really, the more clarity you can provide, even if this is just a very initial step in your ESG rollout, it may just be you want to look at the carbon footprint of each of your companies, or the social impact as a healthcare investor, even if it's just one area. But as long as they understand why you're asking for it and how you're intending to use that information, that's obviously going to go a long way to getting that buy-in. Stefano, do you think there's a bit of a more of an open-minded approach in Europe on this with management teams, maybe compared to the US?
I think Europe, and even within Europe, you can probably make distinctions between certain countries that are more advanced and others that are probably more followers in this. Probably the Netherlands, probably France are further ahead than others on these things. I think there is a growing awareness of ESG. And from my side, I would also add sustainability. When we were fundraising for our first fund back in 2007, many investors would ask sustainability. What is this? Are you the climate change guys? And or maybe there was another buzzword at the time, I don't remember. And we were explaining, no, it's a different thing. And awareness has been growing in terms of LPs and also in terms of management teams. If I look at the latest acquisitions in our portfolio, I think there is a desire to be ESG active. And in particular, good management teams that are capable of delivering growth are also very good. There is a strong correlation. They're also very good in implementing ambitious ESG plans, because in the end, good ESG is good management. The two things don't diverge. It's probably a different language, but many things that you have to do under an ESG perspective, you would do it anyhow under a good old management handbook perspective, because they make a lot of sense from a managerial perspective. And ESG, we are convinced, creates value for this reason. We now do an education program for the management teams of the companies we acquire. So before we do anything, as soon as we close the transaction, we usually organize a meeting with the top management team of the firm, and we explain why we care about ESG, what do we mean with E, with S, with G, what does PRI say, why they say certain things, why we need to care about E and S and G, etc., etc., etc. And there is always I would say, a good reverberation with companies. Our latest company acquired, this is a few months back, the CEO spontaneously told us, I want this company to become a B Corp, which was great for us to hear. And probably we would have not heard that a few years ago. But now, also, if you look at the commercial proposition of many companies, sustainability and ESG, think about gender equality, it becomes also a commercial line. So it's important for them not only to manage, because it's good management, certain issues, but also it's part of the commercial proposition of those companies. So I think it's getting easier life from that point of view.
Yeah. And I think it's important to say as well that Malcolm mentioned earlier that there is this issue with this lack of standardization, which I'm sure platforms like Heidi's are helping overcome, because there's better data capture, and suddenly you're able to start really benchmarking KPIs more effectively and more easily, frankly. But it is anchored, Heidi, in really having an ESG program that is really anchored around the most relevant data. Just because there's a lot of data out there, it doesn't mean it's relevant to you as a specific GP. So what are your thoughts on that, and how can managers best utilize ESG data sets to track their portfolio companies and ultimately tell a narrative, a compelling story to their investors?
Yeah, no, that's absolutely correct that not all ESG data is created equal. There's some that you're going to collect that's not going to be relevant and will be felt more like a check the box exercise. Uh, but truly, I think you had asked a little bit about the difference between perspectives in the US and perspectives in the EU, and I think this is relevant to how that data is being utilized. And really what it is just in the US, we don't have the risk management lens through ESG that
Right.
I think is as developed in the EU. And you can almost think about the situation we're in right now as where health and safety was 20 years ago. So Stefano's straight on where he says that absolutely good ESG management is just good management. That's correct. And that's what we discovered with health and safety as well, too. So we're kind of going along in that journey. And I think the way to make the ESG data meaningful to get the buy-in at the management level, as Malcolm had been mentioning, was so important, is to be orienting ESG data that's actionable. So how are you using it? Let's say you're collecting it in diligence. You're going to want to collect the data that you can then use and turn into the management plans. Maybe it's the 100-day plans. Maybe it's just your goals for the next 3 to 5 years with the company that you're invested in. But actually being able to collect data that you want goals set around that you think are going to be meaningful, and then data that you're going to be able to explain to the portfolio company, here's the risk behind not collecting it. This is why we're asking for it, because it behooves you to think about it. For instance, carbon emissions, we're going to probably pick on that as the most obvious ESG data point for a while, but there's a changing regulatory environment around it. So right now, New York City has net zero carbon targets by 2050. So if you have an investment within New York City, especially if it's real estate or something like that, you can explain to the portfolio manager, here's exactly why this is data that needs to be collected. Here's the risk that could come if you don't at least have an understanding of how it's doing. And once you have the data, that's when you can determine the actions moving forward. So I love thinking of ESG as a risk management exercise because no one wants to have risk that they're unaware of. And I think that's the best way to get that management buy-in as well, too. And then that will also quickly show you exactly what data is going to be material for the risks that are facing your business.
Yeah, very good point. I'd like to take I don't know if my panel can see the question. I'd like to take a question from Bruce, actually. It's more for Malcolm and Stefano. When we think about KPIs, are you able to share any real life KPIs that you are actually using with your portfolio companies? I don't know whether, Stefano, maybe, do you want to lead on?
I can try. As I said, we collect on a portfolio basis 5 KPIs, which, if my memory doesn't fail me, are total energy consumption, total water consumption, eco-innovative percentage of revenues. This is a very EU KPI.
Yes.
Then environmental capex, and then training per employee. And this because they have a high degree of affinity with our sustainability investment thesis. In addition, as I said, then we have a rough company by company list of additional KPIs that we collect and report to our investors. But we are not incredibly KPI focused, as I said earlier, because I think Kylie can probably expand on that if she feels like, but I think KPIs alone don't really tell much. KPIs are meaningful in the context of a certain strategy where you figured out in your materiality that you have an issue which you want to deal with. You figure out what KPI you need to keep monitoring in order to make sure that there is progress and in order to make sure you understand when you arrive to where you want it to arrive. Otherwise, KPIs can be confusing. Think about, for example, energy consumption. I think we were one of the first GPs to monitor and report energy consumption of our portfolio. Well, not easy at all, because there is companies that, thanks to their success, increase energy consumption. There is companies that, thanks to the fact that they are replacing older product with newer, more competitive, better product, just for a mix effect, may increase their energy consumption, even on a per unit basis. Well, the first example you say, well, because you are looking at the total energy consumption. If you go on a per unit basis, you will see that maybe the per unit basis is constant or even drops. Yes, that's growth. But changes in the product mix are not captured almost in any way. You may have a company that is doing all the right things, but nevertheless, because of a mix effect, has increasing energy consumption. So energy consumption is only meaningful as a KPI when it's part of a strategy where you say, I'm introducing this new product. I know that this new product is more energy intensive than another one that replaces, but maybe on a full life cycle analysis basis is a better product for the environment, for the entire value chain that I'm serving. And therefore, I accept to produce it with higher energy cost, but I monitor that its higher energy absorption decreases over time on a unit basis. And then all of a sudden, your energy has a meaning. So, yeah. I mean, they're a bit tricky. KPIs need to be, they're part of the strategy.
Yeah, but it demonstrates, frankly, the complexity to how one thinks about monitoring and tracking the performance of one's investments, because, as you say, you could get misled if you focus too much on one particular KPI. And I mean, Kylie, I don't know or Malcolm, if you want to, before we move on, do you want to add anything to what Stefano was just pointing out, though? I think it's an important point.
Yeah, sure. Our framework is a little bit particular because we are a sector-focused fund. So if you tie back to the ACA or Obamacare in the US, the three key tenets of that were cost, quality, and access. And the nice thread of that is each of the CEOs have that as their lens as to the type of business they run. So we look across our portfolio, we look on the services side, what are the costs of care for the companies that we invest in benchmarked against other costs of care? Are we in a low cost setting? Are we saving the system money comparing to a certain benchmark? Access to care. Or when we look across our portfolio, what percentage of our care centers or services and procedures are just in suburban areas or urban areas? Or are we giving access to healthcare in rural areas? And are we giving access to healthcare to the vulnerable populations? And then quality as well. If we are approached to make an investment in a company that is the highest cost setting, and you can't measure at some basic level the quality, is that the side you want to be on? And is that really improving the healthcare system in the US through the lens of cost, quality, and access? So, you can't bat 1,000 all the time, but if we continue to measure that through our portfolio and say, is our portfolio on the right side of that? So those have been easier for our managers to buy into, because it started a little bit more in definition with the ACA in 2010 and 2012. So building on that in the framework of ESG has been a good start. So I agree with Stefano, you don't have to get KPI crazy. You don't have to have lists and measurements that you're not going to pay attention to or go stale or aren't actionable. Look at the portfolio and say, what's our why here? What's the purpose that we're investing behind? And then start with some of those basic measurements. And then I think it feeds on itself and builds on itself.
Yeah. And Kylie, I think that's a nice way to segue to maybe have you share with the audience maybe just an example of one of your clients who have been using the ESG index, and how that's maybe led to success in terms of how they are running their ESG program, and all of everything that comes with that more effective benchmarking, and telling a more cogent story, because it's data driven. I mean, could you just maybe give an illustration for the audience?
Yeah, absolutely. We have a real estate investor, so private equity company in the real estate market, who prior to using the software really thought that their portfolio was in worse shape than it was, saying, oh, we're sure most of our companies aren't doing a whole lot with ESG. And then when they began surveying and actually finding what policies are in place and certain other elements of the programs, they were pleasantly surprised that the portfolio companies were actually doing a whole lot and just really hadn't had a platform to tell that story before they began engaging. So it helped in a lot of different ways. For one, it helped their own portfolio companies develop ESG stories. So now we're seeing them begin to disclose on websites before where they hadn't been doing it before. It helped the private equity company be able to explain, oh, the state that the portfolio is in is actually really great. It then also informed the ops team as well as the investment team more about what sort of information's out there that can be collected and why is it relevant. Here's how we see it in action. So they ended up rolling out this tool for their diligence efforts as well too. They're not going to ever pass on an investment for ESG criteria, because then you can put an action plan in place and improve based on some of these best practices. But what they can quickly see is go in, say, okay, we do want to invest in this company, but here's the points that they're a little bit behind the rest of the portfolio. Let's make sure that we have plans in place to address some of that. So it's been incredibly positive in that way. More so finding a story where they didn't think there was one. So now they actually have plenty to disclose and are going to be releasing their first GRI-aligned CSR report later this year and have plenty of excellent data points to be able to utilize within that. So I think a lot of times going through the action of collecting the data, it's good because, as Malcolm was saying, it's iterative, it can build on itself, so you can always get a little bit more in depth. Maybe you're only able to collect a fifth of what you want your first year, but by the third year that you're doing this, your portfolio companies are going to be more understanding of the process, and you're going to have that open dialogue as well too. But I think you can also find the data could surprise you in a really pleasant way. A lot of times companies have really strong social and governance policies in places and just wouldn't think to call it ESG. And sometimes it's the environmental piece where that's where there's a perception that there's more cost, and then I think those exercises are a little more straightforward on how to talk through from the risk management lens as well as the cost saving elements.
Yeah. And I know, Malcolm, you were saying earlier that you found that when you're doing some of these assessments with your companies, given again you are a healthcare specialist, it's maybe there's a little more on the S and the G. But are you? I think you and the team are at the moment you are assessing governance and compliance programs as part of your due diligence. I mean, are you finding that actually, like Kylie was saying, actually the data's actually not bad with some of these companies that perhaps you're looking at?
Yeah, I would agree with that. I think companies are better off for the most part if you have that lens at the start. And I think a natural for us, because we don't have the real estate component or industrial component, some of our pharma services companies do deal with waste and more of the E, but a natural component is the governance. And I think the governance has moved even just from a number of financial folks governing a certain type of portfolio to really having more diversity on the board, having diversity of opinion, and also leading with transparency. I think a lot of companies that come into our world are not used to that level of transparency. So if you can get the level of transparency from the board to the management out into key leaders in the field, I feel like there's a better development of trust. You understand the purpose a little more definitively, and there's a little more buy-in as to having, I think, a broader level of decision making in the governance. And it takes away a little bit of the secrecy of a board that I think in years past are typically filled up with folks who have similar skill sets, as opposed to having different skill sets and different backgrounds that can add a lot to the governance of a company.
Yeah, and given, Stefano, that you've been, as I say, nearly a decade into your whole approach to ESG, could you maybe provide an example or just an insight into how how you think about success really, and how you think about the value creation that comes with having a more effective ESG framework to monitor your companies, to see the improvements they're making over the stewardship of your investment, so that you, when it comes to exit, you can show another sponsor or corporate partner, these are the improvements that this company have gone through during our ownership. We can quantify it. I mean, how do you think about that?
Well, I think, as I said earlier, that ESG helps creating value, though it may not be the first intuitive idea one comes up with, but after a while you see it does create value, especially when you really execute on ESG, which, as I said, is somehow correlated with the quality of the management team. So if I go back to the history of the companies that we have been owning in the past, I can think of a couple of examples. In particular, one on the G, and that was the multiple effect at exit. And another company instead where we played more on the S, and that created an EBITDA. I mean, I'm sure everybody's surprised, but using the S well created a lot of EBITDA. The first company was I mean, we bought, it was a secondary transaction. So we bought it from another fund that aggregated a few companies by, you know, buying on an acquisition spree and putting together a few companies, but without really any integration work across. And we bought this with declining financial performances, and we very quickly understood that governance was the main issue. The companies that comprised the group were not coordinated in any way. They were even competing in several countries against each other. So we created a group, which is easy, but it requires a lot of governance effort, easy in quotes. We created a centralized management team. We changed the local organizations into a big matrix organization. We created a reporting system because the numbers of products that cross boundaries across companies, the numbers could not be read, so you wouldn't know the profitability by channel, you wouldn't know the profitability by product family, et cetera, et cetera. So we created all this. And to make the long story short, the multiple at exit with a probably similar EBITDA was double the multiple at entry. We removed minorities. That was a pure governance play.
Right.
In another case, instead, we decided to buy a company that was playing in a cyclical market. Usually, private equity stays away from cyclicalities, right, to the extent you can. But we were convinced that we were buying on the right rising side of the cycle. So we said, well, let's try. This company faces an opportunity to grow revenues by 100% in 3 years, and then we will sell it. Now, to double revenues and extract more than double EBITDA in 3 years is actually quite challenging because we also doubled the number of people. And there we worked on the S. We did a number of S social actions. They went from, for example, creating a kindergarten inside the main factory so that a number of female employees could actually, you know, have no problem with their children, bring them over, and there is, you know, there is a way we can take care of them. We created a bonus and alignment system that usually encompasses top management, and instead in these cases went down to the very last employee of the firm. Everybody had a bonus based on certain objectives. We created communication groups via WhatsApp, for example, for shift by shift. Every shift that finished the production campaign was informing via WhatsApp what the next shift would have found at the moment of entry. And basically, with very limited capex, we more than doubled the production capacity of the industrial assets they run. And we achieved the goal of selling the company after 3 years with a very good capital gain. In this case was really all EBITDA. So the first case was the governance was multiple primarily, while this was unleashing EBITDA because you basically opt-in the entire company as, you know, you embark by working on the entire company on the same vision.
And well, again, both of those examples there, I think it really demonstrates actually how maybe one needs to be very creative. You've got to do things very much, you know, step by step. But you covered off a lot of detail there on just the different types of initiatives and changes, and really tinkering with the system there that ultimately created a far more attractive company than when you first bought it. So, and I suppose, Malcolm, before I let Kylie conclude on this, there's an element of needing to be creative here, but again, do it in such a way that allows you to really quantify those improvements, and again, be able to tell that story to your investors, maybe more on the S and the G side for you.
Yeah, and I think the ESG provides a framework, but in Stefano's example, as I think we mentioned earlier, that's just good management, right? It turned out to be good for the S piece of all the employees, and being creative and finding a way to have them more productive, to have them more focused, aligned around a certain goal and a mission, and that those can go hand in hand. And in Stefano's case, it resulted in earnings and revenue growth, and as well as multiple expansion. So I think, the nice thing about this framework is I think this is becoming more front and center in our society. And I do believe the U.S. is a little bit, at least in my peers and in the middle market, behind where some of the countries are in the U.S. But it can be tied to good results too, and not sit out there on the island. And I think Stefano has done a nice job of pulling that together. And I think there's more good things to come, in the future, where this is tied more as this is best practices and good management and how you run a top tier company, as opposed to a questionnaire where you have to check the box.
And yeah, absolutely. And Kylie, this also, I think, and again, with your platform and with this becoming more front and center, this also overcomes that issue with greenwashing, that it gets leveled at some companies that are maybe just jumping on the bandwagon. As Stefano's highlighted, if you can really quantify those changes over a period of time, that overcomes the greenwashing label that gets thrown around, but also is a way to demonstrate future-proofing your assets. So I wonder what your final thoughts are on that, and just as you look ahead over the coming few years, really.
Yeah, absolutely. I mean, being able to look at that trend data and seeing actual tangible progress being made, that people are improving their scores, that they're getting more and more things in place, that internal teams are even becoming more and more educated on what everything means. I think it's an easy way to show that it's again orienting the data in the action and how it's being used, and that really shows that there's an effect. It's not just you're throwing something on a website because you found a nice case study kind of by happenstance. It's a more systematic way to look at things, and of course broadly across the portfolio, and really at the end of the day too, it's just a way of making sure that you're engaging the right people in this process. The best way to drive ESG action forward is that you have engaged portfolio companies, that you've talked to investors about truly what they need. So the technology that we developed is really just kind of a way of marrying all these processes, bringing them together and giving you the tools for analysis. But I think, just being able to interject that ESG lens into more of what you're doing is going to be the key, and that's going to help, create the stories as well as explain the impact.
Well, absolutely, and I think technology is making a huge difference to that, and helping with all of that data aggregation, and really then starting to compare apples to apples, which is not easy for some managers who have got very diverse portfolios. How do you compare one industrial company to a retail company, or it can be hard to put these benchmarks in place, but I think that's certainly making a big difference with what you're doing there with the platform at Gobi, and this all comes down to, as you say, actionable insights, underpinned by the right data. I mean, that's really, I think, the key takeaway today. But take it step by step. don't expect things to happen overnight, and you know, the earlier you can get the buy-in from the management teams, I think the more likely you're going to be on the road to success. So I think it's fascinating, a really important area, and I'd like to certainly extend my thanks and gratitude to today's panel for giving their time today to talk about these issues. And of course, many thanks indeed to the audience as well for listening in today. I hope we've covered off some important insights for you to think about in your own respective organisations. Thank you for the questions. Kylie and Stefano and Malcolm, I'd like to say good luck for the rest of this year. Keep in touch, and I look forward to speaking with you all soon.